Hello traders, this is Chris. Welcome to Price Action Insights, and today's subject matter is going to be last look practice, which is a practice that's been employed by banks for many years, and it's obviously evolved over time given the changes in technology, but it's a practice that's used for banks to manage their liquidity in order to best account for various provisions in the foreign exchange market. But of course, where there's an opportunity, there's a criminal, and the banks have recently have been fined quite heavily for using the last look window to consistently to their advantage, where the bank has gained the financial advantage at the expense of the client. So let's just have a look at what last look practice is, or called last look pricing. It's a practice where liquidity provider provides a quote rather than a firm price in the trading system or execution venue. Because what happens in the foreign exchange versus, let's say, equities, for example, is that a liquidity provider on the sell side can offer a quote or a price where there is some manner of liquidity available. However, it may not necessarily be available at the time that you execute the trade. So they will put forth the quote, and whether or not there's liquidity backing it remains in question, because if a bank has a large order on the books they're trying to put through, the bank will send the order out to a multitude of counterparties. So, for example, if they have $100, or 100 in foreign exchange language, 100 million is $100. If they got a $100 order come in, they will actually put that $100 order out to 10 or even 20 other platforms or potential counterparties as that liquidity being available. And so it gets to be a problem if more than one counterparty hit that price at once, or a portion of the price at the same time. So, and again, it all depends on how it can get very complex in terms of how the liquidity is distributed in such, because it's a very fragmented marketplace, and ultimately liquidity providers are trying to pool liquidity in such a way that they're trying to make it as efficient as possible to keep the entire marketplace efficient. So therefore, they're providing a quote rather than a firm price. So when a trade is placed, a liquidity provider may, and whether it's a bank, a single dealer platform, multi-dealer platform, also aggregator ECNs, they may hold the request. So they may use what's called last look window, and they may hold it for some time. Now, the time with which the time allowance to hold has been called into question. So call it 250 milliseconds. Some are making it less and less these days, but obviously in the old bank days they could hold it for quite some time. Some liquidity providers are actually going to complete transparency and with no last look pricing at all, but some institutions, in order to most effectively manage their liquidity, they still will need to utilize the last look window. And again, but now with a code of conduct called Principle 17, they are having more transparency in terms of what their time hold allowance might be. So they can hold the request, they can either execute or fill the trade, or they can give you a requote, or they might just flat out reject the trade. So let's just try to have a look at what this might look like from one party to the other. So we will try to keep this simple because it can be somewhat complex, but let's just say that the whole spectrum of the foreign exchange market is represented here. So whether you are a retail trader and you're trading through a single dealer platform or a multi-dealer platform that is on the front end of a liquidity provider, or whether you are a very large institutional trader trading through a multi-dealer platform, or a bank where you have a multi-dealer platform set up individually through your bank. So there's many ways that one's liquidity needs can be built into a most efficient delivery system, either direct with the bank who provides or becomes your prime broker with whom your primary credit is established, and then you of course establish lines of credit with a multitude of other banks, so then you have broader availability of liquidity. So I want to be careful about how much detail I get into on that. I just want to try to keep this simple. So if client A delivers an order to the bank, and the bank is either the counterparty themselves or counterparty through taking an order from one of the other through a multi-dealer platform or another individual bank, then this may be represented only in the form of a quote, and we don't know whether or not the liquidity is actually available. Now, obviously, given technology, this is all happening within a very, very, very fractional period of time, of course, milliseconds. So when customer A puts in an order with the bank, that is, the price has been quoted, then the bank will take the order, and when the market is fairly stable and in a state where relative liquidity is quite efficient, it is quite easy for the bank to give up the trade within its pool of liquidity. Now, when the market price starts to gyrate significantly, or when it moves into an area where the environment of liquidity is much finer or much thinner, and it's trading on in a thin trading environment on best bid, best offer, then the bank will take the order, and the bank will hold on to the order for a fraction of a second, give it 80 to 400 milliseconds. The bank will need to establish to what degree the market has moved, whether or not the liquidity is available. They're trying to protect themselves against being on the negative differential between the bid and the offer. The bank needs to protect themselves from arbitrage or potential latency when giving up the trade. So the bank will hold this just only for that fraction of a second in order to establish what it wants to do with the liquidity next. Now, we've gone through a phase where the banks have held the trades, and the algorithms have established the state of liquidity at any given period of time, and they have used the information on both sides of the trade in order to take advantage of a positive differential that weighs in favor of the bank. And some banks had done it so consistently that they were found to be in breach of trust and code of conduct, so therefore they were penalized quite heavily. And so since then, of course, there's been a lot of discussion around it. They came out with Principle 17, which is just call it a code of conduct. Nothing is really necessarily illegal, but if the bank wants to keep a client, then they're going to have to be fair over the longer term, which is why clients can now employ various means by which they can establish how consistent the banks are for overall long-term costs using transaction cost analysis, and which I'll discuss a little bit later. So this just gives you just a little bit of an idea of what that framework can look like. And so if you're a trader and you're dealing through a single dealer platform, and you have a very narrow, very small liquidity pool, then the same can happen, but it's happening on a micro scale. So that just gives you a little bit of what the framework looks like. So again, think of it this way: that the prices that are being quoted on best bid, best offer, and again, the even at best bid, best offer, the representation of liquidity in the marketplace is or can be considerably more than the actual liquidity available, which is often what happens when you see volatility increase, and particularly at certain points of the move. So I think it's important that you review some of the videos that I've done on price delivery. because we've done a lot of study on this and a lot of study with the banks and with some of the banks technology guys, and so the information that's shared here can be supported, and you can build out your knowledge base based on looking at some of the other videos, because it's very much understanding these aspects of volatility are very much a part of how we trade. So all right, so now we can just have a look at what this can look like on a chart. So when you're sitting at home and you are watching volatility on a chart, unless your chart is smothered in indicators, if you're a price action trader, then you'll see things quite differently. But if your chart is smothered in indicators, you often just don't see simple movements that are occurring behind the scenes. All right, this is a pound dollar 1 minute chart, and I should probably even take it down even lower, but this is a 1 minute chart, and it's live now, and we're on a Friday, so we're just price is starting to slow down at this point, and then we can maybe do some examples at some point when there's more volatility. But let's just look at a couple of these cases, like these cases here. Now, elastic practice is a little bit more visual or present when the market volatility picks up. So what I'm going to do is I'm just going to freeze this shot so I can do a little drawing. So it helps if you've seen some of my previous videos on price delivery, so that you've got an understanding of what goes on behind some of these movements. And I explained how quite often when a move gets started, we start in a low liquidity state. So you've got a low liquidity state base right here. Then you can see how this candle, this one has a certain length to it for the 1 minute period. This one is longer. There's no wicks between the two, so there's no real up and down volatility. So liquidity is sparsely present along this move. And what happens is when this move started, the availability of liquidity was fairly thin along this space, and then you probably add a little bit of a liquidity pool up in this area right up here. So what happens is when the price run hits, when the volume surge, so you have like relative volume liquidity kind of balanced here, so you've got nice even flow on both sides of the market. Let's just take a visual of that one as well. So here you can see some depth of liquidity quote tickets here, and this is just Euro dollar and dollar Canada. So you can see what we look at here is we'll look at tick frequency here, not so much on the volumes. I mean, the volumes are pretty it's the same. This can actually be adjusted in terms of what volumes you see here. But typically when you've got a low state of, where did that go? The low state of liquidity right in here, when you get to the lowest state of liquidity, you're most subject to a volume surge hitting on one side against a weak spot on the other. So the bids may have a bit of a volume depth coming in against a bit of a weak spot on the offers, and so price starts to move, and the movement is, of course, is a function of available liquidity, not only behind the move at the base, but then as price is pushing up, here you can see that price is pushing up into a thinner availability of pre-existing liquidity at these prices prior to the market moving into that area. And so then you probably had, if you looked at a higher time frame, you'd probably see some good price relationship as to why it would have stalled up here, and then the bids dried up, and then price just bled back to the last base of liquidity. But let's just talk about what happens up here. So we'll start this over here, just to give you a little bit of a background about this this volume base right here. And so you would have had a little bit of thicker liquidity as this got going. So again, the algorithms change slightly, and so as price starts to move and it starts to tick on multi-tenths surges, you'll often see at the end of the surge, you sometimes might start to see a little bit of an increase in price requotes or price rejections. But then when price really starts to run, it probably had some liquidity up here again, and as price starts to run, looking for the offers, as you see the move gets thinner and thinner and thinner and thinner. And what's important to remember from some of my previous videos is that the market is trading at best bid, best offer. Okay, best bid, best offer. So if price has moved up here and you're trading at best bid, best offer, you are trading at the thinnest end of the price quotes in terms of available liquidity. So the depth of liquidity is going to be much deeper. So the best bid and the best offer is going to be the thinnest availability of liquidity. So as price gets up here towards the end of these moves, you'll often see price quote rejections, especially if it's a fast rejection. Like this one here is a little faster. I should probably pull up maybe a tick chart. You see how we have this wick up here? Price rose and then it just dropped quite quickly. Here, this is where the type of area where you get price quotes, because you're trading at best bid, best offer up here, and these are the areas where we like to trade. But it's going to be the thinnest end of the market. So if it's the thinnest end of the market, the bank is going to want to either reject your quote because they don't have price available at that end of the market, or they want to hold the liquidity briefly to see if they can offset it either positively or avoiding a negative differential and getting clipped on the trade based on latency, or there's not so much arbitrage or too much efficiency in the market these days for arbitrage, but it's called, it can be like incidental arbitrage based on failure of the mechanics of their algorithm. So that's what happens up here, and this is where the last look is most likely to be employed. And anytime you get like a price surge, and then quite often these will wick out. Let's have a look and see if we can find a couple examples. So when you have scenarios where you've got these little mini price runs that are going along all day long, anytime quotes start getting up here, again, you're trading at well, not so much there. This is pretty early in London session. This one is a pretty small move, but moves like this, as you start running up, and even in the course of the run, you'll actually see some distinct price disparities as prices. It can rise, it can do multi-pip jumps and then multi-pip falls. When you're on the end of those moves, you're potentially subject to price requotes. There are a good number of brokers now, and it's becoming more and more. It's getting a lot tighter now, where last look practice, of course, is frowned upon. A number of brokers, be it institutional liquidity providers, banks, and even single dealer platforms, are moving away from the practice. And if you want some suggestions on what brokers, you can let me know in case you're experiencing price requotes. But this is the type of area where you'll often see the price requotes. But what's important to us is that we like to trade these moves, so we are watching the move. So effectively, the way we're trading, without getting into all the details, we're looking for a price move into a level where we believe there is a strong presence of liquidity, where as price runs, it's getting thinner and thinner and thinner, and then once price hits the liquidity, then it's likely to suck up the bids, and then price will fall. So and what happens with the institutional platforms is they'll identify that there is price disparity, and it's thinner bids and offers coming in both sides. So therefore, they are more reluctant to commit to being counterparty to a trader offering up liquidity, because again, they might find themselves on the negative side of the price differential. So so that's what happens. But this is where we like to try to enter based on the overall spectrum of the information that we use to trade, price action traders. So so that just gives you a little bit of a visual as to what goes on behind the scenes and from a price action perspective. I'll just show you one more example to bring in another dimension to it, is that when you can see here, it's getting longer and longer and longer, and then this one here, was quite long, but of course it topped out here. And again, this is the area right in here where you would see a lot of price recruits depending upon the nature of volatility in that area. And then what happens here when you get when the consolidation holds like this, all it's done is it's hit an area here where there would not have been, as on a relative level, not as much presence of liquidity here. Therefore, the bids were able to draw up and and accumulate up at this level rather than leave. You see here how we've got a little bit of a void here. This measures new price changes. Left a little bit of a void here, and you can see that void is fairly close to where this liquidity was here, because once price breaks through, you see how it just stalled right there briefly. Once it breaks through these types of areas, it moves into a new liquidity environment, and that's why you often will see a direct move once it gets past like highs like this. Even though this is just a 1 minute chart, on an intraday level this is making new highs. So therefore it has moved from one state of liquidity here into a new state of liquidity, and therefore you see the volume and the price quote environment change, the tick frequency change, and then as price is rising, and the reason why price is rising the way it is again because the bank algorithms need to have protective mechanisms in play while they are filling orders. So and then price just comes here and just starts to accumulate at a higher level. Typically that happens when there is less liquidity that has been pooling in this area. You got a pretty strong price move, and then the bids just draw right up in this area. I know that's very obvious, but it's not obvious when you compare it to when there is more liquidity available here. It sucks up the bids and leaves this void, and price will drop a lot more aggressively down into this area. So we actually just had an event here on the pound where we moved from 36 to 48, just a 10 pip move. You can see how the candles got longer and longer and longer. So what it's telling you is it's pretty simple. It's we're having to move further to find liquidity over the same period of time. So over each 1 minute period, price had to move further to get filled. So therefore it's moving into a thinner and thinner and thinner environment, and then price just draws right back and will rebalance out. And one of the places it will do it, of course, is right here before it moved into a new environment right here. And that's why you get a price response right here. For those of you who are into scalping, I mean, yeah, obviously you've got to know this on a much deeper level, but this is a fairly common movement right here where this is going to see some response here. I just had the move on the euro as well. You can see price started out, and then it got quite aggressively higher, and the very end of the move is quite thin. You can see it just wicked out over a short period of time, and now it's just drawing back, and it'll probably pick up a little liquidity right here. So just heading back to some of our notes here. If you think of the equities markets, the equities market is it's an order-driven market, so liquidity is available, whereas FX is a quote-driven market where the quotes may not necessarily represent liquidity depending upon the dynamics that's going on behind the quote in terms of the available liquidity over the broader marketplace. So the aggregate market depth can well exceed the available liquidity represented in the market. Arbitrage is more for the older days. It has to account for latency. Again, depending on where you're trading from, there could be some time. We always measure time it takes to get to the deal, depending on where you're at. You should have a measurement tool for that. So the risk to the bank is to the client and losing the client. So what the bank will do is before Principle 17 and before the fines to some of the major banks, the bank was always weighing the holding time to their favor. And so now what the clients will do is they have better assessment tools to determine how often the bank is weighing it in their favor, how often it is in the client's favor, and how often it's somewhat neutral. So if you look at a couple things here, the technology is improving. So last look hold times are changing, they're getting narrower to maintain efficiency, and the gain loss to the bank or of the bank is coming more into balance as transparency increases. So, but there's a new tool in the market that's called transaction cost analysis, and so if you are on the buy side, you can use the transaction cost analysis tool to determine to what degree you may be suffering some of the consequences of last look. So the at some level, the banks can lose a bit of control of managing their liquidity. So what happens is they will widen their spreads to mitigate arbitrage and latency risk. Let's have a look at that. So as price spikes up, as you get towards the end of the move, again, you're at the best bid, best offer, thinnest part of volume depth. And so what will happen is you will see the banks will widen their spreads to account for any potential risks that may be posed in that environment when price does spike up like this. So, which is why we will use a tool to deliver liquidity into the market on our own terms within a pip tolerance and volume allowance, so that we maintain control over the liquidity. And if it doesn't get filled, it doesn't get filled, but at least it's on our terms. So that's what happens here: is the banks will widen their spreads to protect themselves. So I think that's all I want to cover on that one today. So, and again, my name is Chris. I can be found at protradersclub.com. There's a free members area, as well as there's paid services. And some of the videos in the either area, really. I mean, paid services has far more detail than the free members area. But if you go in the free members area, you can check out some of the other videos that may help you to get a better understanding of some of today's coverage. So that's it. Good luck with your trading. Be careful there. This is Chris.